everyone. My name is Dr. Melissa Cohen. Welcome. Today I'm going to talk about the ups and downs of the stock market. So just to give you a little bit of historical perspective about the stock market, because I know a lot of people are in angst, anxiety, 1,000 other descriptive words that I'm not going to spend the time on today with the stock market. So I'm just going to begin. Look, this is a graph. The stock market is cyclical, which means it goes up and down, but over time it actually trends up. How do you know that? You can go back and there's historical information, and I'm going to go through some of those details with you today. So the best advice, and I'm doing my research too because I want my money to grow and I don't want to lose money. It's awful when you log into your accounts, your retirement accounts, and you see you've lost significant amount of money at this point. And so what's the best thing to do? The best thing is to overall stay the course. Now, here's my little financial disclosure and legal disclaimer and all that information. So this is just past performance of the market, and the stock market doesn't indicate future financial performance as well. But I'm going to go through and we're going to look at some of the historical numbers and such, so which will hopefully help you put at ease. We know the mantra of the stock market: buy low, sell high. The market goes up, everybody wants to get on the bandwagon. The market goes down and people start selling out of fear and they don't want to lose money. Here's the problem though. You see the stock market going up and you hear all your friends saying, oh, I'm making a lot of money. I've gotten 10, 15, 20% returns on the market. So they may buy here. So then you're like, okay, I got to get in. I got to get in on this one. You buy here, it goes up, and now it's going down. And you sell down here. So you're not buying low and selling high. You're buying high and selling low, and that's not what you want to do. So there are some other general rules of thumb about the stock market. So any money that you need within the next 5 years should not be in the stock market, especially if you're getting ready to retire within that 5-year mark, because the market is cyclical and you want to sell when the market is high, not when the market is low. So there's a couple of things I want to go through here from a historical perspective to look at to give you hope that the market will continue to go up. So at this point, you also have to consider the market was roughly about 31,200, I think, as of close on Friday. And mid-May here, I can look at my calendar here, May 20th. And that's still pretty high when you look at where the market has come when it hit that 30,000 from the Dow Jones. The Dow Jones line was the 31,200 roughly last week. So the market, it took many years for it to get to 10,000, many years to get to 20,000, and an even shorter time frame to get to the 30,000 mark, which is just the value of all the stocks and such that make up the Dow Jones. And that's the index that I'm just looking at. There's obviously several other ones you can consider as well. All right, so I found this article. It was in, let's see, it's a history of market ups and downs, and it was April 3rd, 2020. So as you can recall, March 2020 is when all the COVID things happened. The market went, if you go look in any of these stock market graphs, you'll notice like the S&P 500 or the Dow Jones, there was a sharp decline in March 2020 for that. So this was written right after that time frame, but this is going to give you some historical information as well. It's vbjusa.com, and you can see the information across the top for the website, and I'll link it into the comments as well. But the historical average of the stock market, since it's been invented over 100 years ago, is about 8%. That's the average annualized returns. So that means some years the average year went down and some years the average returns went up. But the average annualized returns is what did it do every single year since it's been counted, and let's look at those annual returns, and it's 8%, right? So that should give you hope and value, or it should give you hope that the value of your account will continue to go up. Probably, maybe not this year. It may take a couple years to rebound, but that's what we're going to discuss here quickly. So this person had researched, so since 1926, they've had 8 16 major market declines that yielded an average drop of negative 28%, and they lasted on average 12 months. Okay, so 12 months, right? So what do we say about the stock market rule? If you need anything within 5 years, it should not be in the stock market, right? So the average declines lasted 12 months. So this kind of gives us some more information. So it says, on the other hand, coming out of each of these down markets, they've had markets with an average gain of 176% that lasts 58 months. And that's almost 5 years. And so, it just talks about some of this information. Downturns, everybody's pain. It hurts. Nobody likes it. It's anxiety. People want to take their money out. But once you take your money out, you cement your losses on your account. If you try to time the market of when to get back in, you may miss that mark as well. So historically, people say, analysts say, financial planners say to stay in the market and just ride it out. And that's why you go by that 5-year rule. But specifically, I wanted to bring this note up with this history of market ups and downs. And this was by Todd Piszczek. It's down here at the bottom. But it looks at the S&P 500 total index in US dollars, January 1926 to December 2019. So that's almost 100 years of numbers and stats and that we can look at here. So as you can see, so the blue is the total gains and the red are the total losses. So just from a visual perspective, you can see there's a lot more gains, a lot more years of gains than there are the red, which is the gains, the losses, and the time frame for those losses. So when we get that 8% of the historical returns for the market, annualized returns, that includes everything. That includes looking at what happened with the Great Depression, that happened with September 11th, 2001. There's other bombings, World War II. It also looks at all these different wars, impacts. The COVID, March, I told you, COVID-19, March 2020, when the world kind of shut down there all of a sudden. So all of those factors are taken into consideration when we look at these 8% annualized returns. The point that I wanted to make is that the market is going to go down and the market is going to go up. Hopefully we want more ups than downs, but right now it is down. So here I'm finding another article here of I want to give credit to where credit is due, but this is some common sense when you're investing in the stock market. The best course with your 401k amid choppy markets, and this is a CNBC article here. So just so that people when it starts to go down, they want to sell. Well, when you sell, you're going to lose your money, right? That's the fact. If your account is down, it's going to stay down. So what does the experts at CNBC say? Basically, don't panic, sell. They say, I don't know how true this is, that when the markets are down, there might be, you have to look for when there's up days in the market as well. So I'm not in the day trading. That's a whole different level of sophistication and knowledge and expert level that you need to do, and I don't have all the time for that. But what can you do right now to help alleviate? Well, and even my husband was freaking out too. He's like, oh, I'm like, don't look at the accounts, first of all. Just stop looking at them. That's the first thing to do. The second thing is look at your allocations. If you have, he's still contributing, or we're both still contributing through your employers. Well, if you don't want to put any more money into the stock market right now, that's okay. That's your choice. Just have it in cash sitting or find something else to invest in, right? But on the other hand, I would say it's a fire sale right now, right? I've heard that all over the place. I love that. Is if the market is on sale and somebody said, look, you can buy Amazon stock for $2,100 and a year ago it was over $3,000. Why would you not buy it? Okay, so you have to kind of put that, those fear aside and say, I'm in this for 20 more years, right? And I am personally, I'm in for 20 more years at least. So you have to kind of change your perspective and what your long-term goals are. So stay with your goals. The other thing is revisit your allocations. So maybe if you haven't looked at your portfolio and you're 10 years from retirement, do you need as much stock, or should you do bonds or cash or real estate? So this is a good time to revisit your overall financial portfolio, not just your stock market investment. So definitely call your financial planner, any stockbrokers, if you need to make any changes to that. This may be a good time, it may not, but they can provide you with, a professional can look at your personal financial situation and provide you that individualized information that you need. Okay. Another thing, I think we've heard this to beat around the bush for the last 2 years now, is have plenty of cash on hand. So as I said, if you're getting closer to retirement, most of that money you have should be converted to cash, or available cash, either in a high yield savings account or something that you can redeem quickly. Obviously, you're not going to make much money, but you have that to live on. The other thing the rest of us have heard is we need whatever emergency fund we had, 3 months, 6 months, you may need a year, you may need 2 years, depending on what your financial limit is, your financial comfortability is, and such. And hopefully in a couple months we'll get to look back and say, that was rough, but because I stayed the course, my money is now back up. I feel more comfortable, I feel more secure, because I'm on a 20-year financial plan to retirement, not a 2-year, right? As I said, market goes up and down. You want to buy when it's down, you want to sell when it's high. And the last piece of advice is to seek the professional guidance. As I said, everyone's scenario, financial responsibilities are so different. So you have to do what feels good to you. But if you take your money out when it's low, you're obviously going to lose your money. You cement it with those losses. I hope this helps you feel a little bit better, a little bit calmer about your portfolio, and that you are on track. You have a long-term financial strategy, and that you're staying with it. And if you have any questions, I can help you research some answers, get some information to you as well. Hope you have a great day. Thank you for joining me.